All right, thank you everyone for reading through those disclosures and welcome to another one of Avant-Garde Trading's free educational webinars. We are thrilled to welcome our guest presenter, Keith Harwood. He is visiting this afternoon in order to present to you all on evaluating volatility with a technical trading focus. So thank you for being here this afternoon and taking time out of your busy schedules to join us live. Keith, are you with us?
Yes, I believe so. Thank you for having me.
Wonderful. Thank you for being here. Your mic sounds really good, so no issues there. Whenever you are ready, you can go ahead and take screen control and pull up your presentation. For everyone who is in a Zoom room with us live, if you have questions during Keith's presentation regarding what he's talking about, please type those questions in the chat box or the Q&A box, and I will get those over to him to address at the end of the presentation. Thank you so much, Keith. I can see your presentation, so feel free to start.
Excellent. Thank you again. And thank you again for everybody attending today. We've got a lot to talk about here. And the big consideration that I wanted to discuss today was how to evaluate the implied volatility of markets and how the markets are pricing in expected movement. Because options can be a great leverage tool and a great defining risk tool, but they do have new risks that are not always seen by every investor or trader. So before we get started, I have my own disclosures as well. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. I'm not an investment advisor, not registered with the SEC or FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. I'll give you a moment here to read through the rest of these disclosures, and then we'll get going on the topic of the day. For those of you unfamiliar with me, this is me. I started my career in the option pits of the CBOE. I've kind of traded everything at this point. I started at the CBOE as a market maker, traded through the subprime crisis, one of the biggest market falls here, I think, in most of our lifetimes. And it was quite a volatile time, and that really got me that much more excited about options and everything that they can do for a trader or an investor in terms of defining that risk and or providing leveraged returns. But as markets shifted and became much more electronic, I moved off floor to manage different types of portfolios. I've traded the options on the European bonds, the balloon, bubble, and shots, the equivalent of our 2, 5, and 10-year. I've traded as a portfolio manager the precious metals, gold and silver. I've traded with a CTA, commodities-based hedge fund, and managed a lot of their option strategies for the book. And they taught me a lot about technical trading. So after getting my MBA, I worked with them, and they taught me about technical trading, and I worked with them on pairing the right option strategy for their fundamental and technical opinion on where they believed a commodity would be going. That really got me that much more interested in using technical trading as my main focus on my personal trading, along with options analysis, in order to find that maximum expected value trade, the one that could really give me the best return given the risk I was willing to take, my risk tolerance. And I decided that I should use that information to help work with traders of all levels on determining how to best leverage and define the risk in their portfolio and understand the associated risks with utilizing options. And that's why I joined Option Hotline back 6 years ago to share that expertise in options, equities, fixed income, commodity trading, and really help hone in on what can be done and what needs to be understood when getting into an options trade. Because you'd be shocked you may be shocked to hear that a lot of people misunderstand the way the options work, the timed expiration. And of course, implied volatility can be a complex input to the options model that can be easily misunderstood. And so with that, if you do have to leave early, you can always feel free to email me, Keith at optionhotline.com, or call me 312-600-8004. Also, keep an eye out for support at optionhotline.com. There will be some free giveaways, so I want to make sure you guys get those, okay? If you do have questions, please throw those into the Q&A box or the chat box, and I will address them as I can. Very least, we'll get to them at the end when I've gotten through the rest of the topics, okay? So what we're going to discuss today is first off why I use options. I touched on that a little bit from a background perspective, but I want to show you guys a little bit more about how options can work as a leverage tool, and the trade-off that one gets with options versus stock. I'll introduce some of the options Greeks, and we're really going to focus today on Vega and the second derivative of that input. So as volatility changes, it changes the value of an option, but it also has an impact on the risks associated with an option that are a little bit different from just the actual value of the option. How I get into trend trading with a focus on Vega and the signals that I use for that. And those second order Greeks, like I said, we want to talk about those at the end here to make sure that people understand how the risk of their options trade can shift with changes in implied volatility. Always keep in mind that options do have risks that are different at times than stocks. The transaction costs are often higher in options than in stock trades because they are representing leveraged contracts. Short options positions do have an assignment risk. So even if you go into a spread position or a complex options position, there is this new risk of assignment. And if you get assigned on an option, i.e. you've sold an option and the owner of that option decides to exercise it, you now have a stock position which will have different requirements in terms of margin and different risk profile than an options position. Options decay in value over time. So if you are buying options or selling them, they will become worth less and less over time as they are an insurance-based contract with a defined amount of time for that insurance kind of contract to kick in value. And of course, the key for me for today is volatility. The value of options is partially dictated by the implied volatility, which is the expected future movement. And that's constantly changing as people reevaluate their perspective on the markets and how they think the markets can move and how largely they can move. There are other risks to consider, but these are the ones that we're really going to cover today. So I wanted to focus on those, particularly the volatility aspect. So first things first, this is part of why I use options. This is a simple graphical representation of how options pay out relative to stock. So first we're going to start with stock. What if I have a $100 stock and I think it's going to go up 20% in the next month? And if the stock goes down by 10%, I want to get out. If I have $1,000 that I'm willing to allocate to this trade, in terms of risk, I can buy $10,000 worth of stock or 100 shares at $100 a piece. And if it goes down to $90, my projected stop loss, I get out and I lose $1,000. If it goes to $120, my projected price target, looking to get out and make $2,000. So it's got a decent risk reward profile. I've got twice the upside to the downside. I think that there might be a skewed distribution here with an upside bias. I'm looking at a potentially decent trade here. Now, alternatively, instead of just buying the stock and setting these other parameters, I can define my risk and add some leverage by buying a call option. Now, for those of you not familiar with options, the option gives me the right, but not the obligation to buy the stock in a call or sell the stock for a put at a certain price, the strike price, at a certain time that's at or before expiration. And utilizing that, I can define my risk. Okay. So what if those options trade for $5 a piece? They have to trade at a premium because they are giving defined risk and leverage. And I don't have to put up the full capital up front. So at $5, that's actually 500 because each call option represents 100 shares. And I could buy one call option for $500, or if I want to have that same $1,000 of risk, I could buy two call options for $1,000. And now I control 200 shares of stock. If the stock is trading above $100 at expiration, I want to exercise my call because I could make a profit here. I could buy the stock for $100 when it's trading for greater than $100. However, I need it to go up to at least $105 a share to break even. Because I paid $5, I need upside in order to make money. Now, if it goes down, I do nothing. My options expire worthless. So I've lost my $1,000. That's that trade-off. If the stock doesn't go up, I'm losing money. But you can see here that on my price target of $120 per share, I actually have a significantly higher profit. Now I'm making $3,000 on my trade instead of $2,000 because I initially invested $1,000 and I've got 200 shares represented instead of 100. I can make that $4,000 minus my $1,000 initial premium. We can compare it here. If I wanted to be long the stock, my 100 shares is a better trade as long as we stay between $90 a share and $110 a share. But above $110 a share, I make more money. Below $90 a share, I still am capped out with only $1,000 of risk, because if I wake up tomorrow morning and this stock has an outlier event, it guides on earnings poorly, something like that happens, I am already out of my stock. I just don't exercise my calls. I only lose the premium I invested. If the stock is trading $60 a share, I lose $1,000. If I'm in stock and it goes down to $60 a share, I lose $4,000, not the $1,000 I would plan to stop out at. So we have to keep that in mind when going into these options trades, because I'm looking for both that defined risk to the downside, just in case, and I'm looking for that leverage to the upside if I'm right. But I'm giving up this window in between where if the stock stays unchanged, I lose $1,000. So I not only need movement when I'm buying a call, I need movement in the direction that I'm looking for in order to profit, and or I need movement way down in order to feel better about the fact that I didn't have that undefined risk to the downside. Okay? So that in a nutshell is why options get very exciting for a lot of people. We are looking at this opportunity for the upside and that defined risk. I can sleep easier at night knowing that my risk is fully defined no matter what if I'm buying options. Now, how do I value this thing? There's a number of inputs, and there's 5 main inputs for the Black-Scholes model, for those of you that are not familiar with it. The first one is the underlying price. That's given by the market. The underlying price is just where we're trading right now. The strike price, that's given by the market, but selected by the trader. So if I want to buy the $100 call or the $105 call or the $110 call, I can do so as long as that option is listed. There are ways to get individual strikes listed that are different from the market, but that's a little bit more complicated and I don't want to get into that. But generally speaking, we have to select from the menu given to us by the market on these strike prices. The time to expiration, that's set ahead of time. That doesn't change. The expiration date doesn't change. The time to expiration shifts every day, right? The options expiring on October 18th currently have 10 days until they expire. Tomorrow it'll be 9 days. The next day will be 8, et cetera, et cetera. And the risk-free interest rate, that's just generally given by the market. We are now at a regime of having slightly higher than 0% interest rates. So that's becoming a bit more of an interesting input, but generally speaking, I don't get too involved with the risk-free interest rate as we look at these options trades that have 6 months or less to expiration in general. Implied volatility, however, that can be estimated by the trader. It is somewhat given by the market. When we see market prices, we can calculate the implied volatility and determine if it's priced correctly given market conditions. Are we pricing in a fundamental event that is upcoming? Are we pricing in a technical inflection point? The answer to the first is usually yes. The answer to the second is usually no. That's where I can get an edge with technical trading, because the market knows when earnings are coming. That JP Morgan has earnings on Friday before the market, but it doesn't always realize when we're sitting at a major level that could cause massive inflows or outflows if we start to exceed a certain price and get this technical input that gives a shift in market sentiment and starts getting all of those program trades excited about that stock or really pushing it to new lows to see if they can stop everybody out of their positions. All right. What does this volatility really mean? Well, the realized volatility is what we've seen occur recently, and implied volatility is what we're expecting in the future. The VIX is an index that tells us what the current market is expecting for the future S&P 500 index movement. This is often referred to as the fear index because it goes up when markets are panicking. So what we normally see is that it's inversely correlated to the stock. When the market is going up, fear goes down. People are getting more comfortable. The VIX tends to fall. But when we see a collapse like we saw in August on non-farm payrolls, the VIX spiked, it exploded. People were panicking, looking for insurance on their long stock portfolios. Because remember, most of us are naturally long the stock market via retirement accounts, investment accounts, etc. Very few people are outweighted to the bearish side of the market in general. Okay, most people have some sort of long exposure to the economy and to the stock market. So when I'm seeing a VIX spike, it means the market is expecting future volatility, lots of movement, up or down. When the VIX gets low and into a lull, they are saying the market's going to be relatively calm. And when the market is calm, that can be a lot easier to find these technical setups, but it can also give me cheaper options execution, because when the market gets calm and the VIX gets low and we get to an inflection point, I can improve my probability of success by having a clearer technical picture, but I can also improve my probability of success by getting my options cheaper. Now, the main option Greeks that we look at when we are going through a trade are the delta, the theta, and the vega. These are the mathematical derivatives that estimate the profit and loss impacts of various shocks to the market on the option value. What does that really mean? Well, every time a day passes, my option contract gets cheaper because of the passage of time. That's theta. Every time the stock goes up $1, my call options should increase in value, because the market going up $1 increases the value of my call option. If I have the $100 call and we're now trading $101, my option has to increase in value because I have a greater interest in buying the stock for $100 a share when it's trading 101 than I did when it was trading 100. I can go to the market and pay 100. Now I can no longer do that. I have to use the option to buy the stock for 100. Rho is that interest rate. We're not going to really touch on that right now. And then implied volatility, that's what we're focusing on today, is vega. That's the change in the option value relative to the change in implied volatility. So when people start expecting increased movement, that shifts the option value. And this is where I think a lot of people get confused by their options position. You know, I buy a call, an out of the money call. So let's say it's a $100 stock and I'm buying the $110 call. Just because the stock goes up doesn't mean the value of that option is going to go up. If that rise in price is associated with also a fall in implied volatility, I can lose money even though the stock went the direction I was predicting. Now, on top of that, we've got these second order Greeks, and they have an impact on where my risk is focused. Vama and Volga is the change in my vega relative to a change in implied volatility. If implied volatility going up means I'm going to have a larger vega position, it means that as implied volatility is rising and I'm profiting off of my vega, I'm actually also increasing my vega risk. I have to keep that in mind. And as passage of time happens, every day that passes, my vega tends to go down. We'll look at a graphical representation of this as well so you can understand it better, but that means that I have less vega risk for passage of time. So if my bet is that implied volatility is going to rise and a week passes before it starts to rise, I can still lose money because of that theta and because I didn't get as much vega in my position as I wanted. I didn't have as much potential change in my option value because my vega position has lowered. Okay? So let's just visualize this vega by looking at what happens to an option when implied volatility rises. So if we have a $100 stock with a $100 call, so right at the money, as implied volatility rises, you can see that the value of that option rises. No matter what my time frame is, it's going to be rising. It's the magnitude that it rises that differs. 100 days to expiration, it's rising more than 67 days to expiration or 34 days to expiration or 1 day to expiration. You can see that as we go to the highs here, these distances are spreading out because the vega is more for more time. As the time goes, or as the times go, or as the value goes lower here and implied volatility goes lower, it gets lower here. Okay. So as we're seeing, that increase is also more rapid in longer term options. Further, when we go out of the money instead of an at the money call, like a bullish $120 call where I'm expecting the stock to go way up, that value increases parabolically. All right, so more time and further out of the money, those options tend to get that much more of an increase. But net, notice that the 100-day to expiration at the money calls have more vega, even though these move at a greater percentage basis. These move more on an absolute basis. So at the money calls are going up from say $5 to $8, $3 of increased value, while these are going to go from 40 cents to $2, only $2 of increased value. Okay, so there's more Vega. These just move more on a percentage basis of how much I initially invested. And that's the big thing with Vega, is trying to figure out what's going to increase the most on both an absolute basis and a percentage basis. And that's the big thing of it, is if I'm buying into out of the money calls that have high implied volatility, and implied volatility falls, let's say we were waiting for earnings came out, the stock didn't move, and implied volatility collapses, I'm going to lose a bunch of money anyway, no matter what option I buy, but I'm going to lose more on a percentage basis for these out of the money options than I am for these at the money options. These options go down by about 40% or $3. These options go down by about $2 or 80%. So larger percentage losses, larger absolute losses. All right. So what does this really mean? Vega, as I said, is that change in option value related to the change in implied volatility. And implied volatility is that expected future movement in stock, and it's priced in percentage terms. When I'm looking at implied volatility, there's a simple calculation that I want you to keep in mind here. If you see an implied volatility of 16%, that means I'm expecting this stock from random behavior to move 1% per day. I take the implied volatility, I divide it by 16, and that is the back of the napkin calculation for how much this stock should move. All right, it's divided by the square root of time. So it's priced in year. 16% means we're expecting the stock to move 16% per year. There's 260-ish trading days per year. The square root of 260-ish is 16. 16 squared is 252 for those wanting the exact number. Sorry, 256. And so what we're looking for, though, is in order to estimate the expected daily movement, it's to take that implied volatility and divide it by 16. And you can do that for all sorts of different terms, but that's my normal look. I'm looking for 1% movement in a 16 vol stock, which is roughly the S&P 500 right now is around 20% implied volatility, which means I'm looking for about 1.25% every day. That may seem like a lot, but when you get the direction right, it can be a lot lower percentages. I don't need 5% in a week for that implied volatility to work when it's only at 1.25% per day. Okay. What it does set me up for, though, is when I get a technical setup like a trend channel, I can start to estimate my expected daily, weekly, monthly move based upon staying within the trend channel. So this is where it gets exciting for me, is if I can find a stock that's going to be on a trend with a predictable rate of appreciation, as long as it stays in that trend channel, now I've got something. I can take my expected move, my expected rate of move, and compare it to the options market and see if it's priced correctly. That's where I can really maximize my potential return, because if the market is pricing in a 1 month return of 5%, and the trend channel is currently at a slope of getting 10% per month, the options market is underpricing the trend. So if I have those setups and I can go back and calculate that implied volatility, then I'm going to get leverage. But if I'm getting a situation where the market is expecting 10% monthly move and the trend channel is only 5%, I have to change my option structure. I might look at a debit spread or a credit spread, something that is going to reduce my Vega exposure, because when I spread my options position, I change my Vega exposure. When I'm trading an outright option, such as buying a call, I am long Vega. So if my implied volatility is too high because my trend channel is much, much shallower than my option implied volatility, then I've got leverage there. As long as that slope is high relative to implied volatility, I've got leverage. If implied volatility is high relative to the slope, I don't have leverage. That's also going to have a bigger impact on those out of the money options, which gets a little bit more crazy, frankly. So as we see that trend channel and the market starts to understand it, they may start to raise that implied volatility as well. And that can give me that benefit on those out of the money options, even if they don't get into the money. So even if we don't run all the way to $125 a share, the $120 calls, as we've seen, do appreciate in value from a simple realization from the market that implied volatility is priced too low. Now, the initial trend trading signals are a little bit too much, I think, today, given that we've got a finite amount of time. So I'm going to send you my 5 indicators for trading success ebook separately. Flip through that. If you have questions from that, you can email me, keith@optionhotline.com, but that's going to come from support@optionhotline.com. So make sure you take a look at that email, run through that, because that's going to help get you the idea of how I get into these trend channels when they are first forming, as opposed to trying to jump into them late in the game. All right. Now, once I've got this all set up, I start thinking about the second order option Greeks. How is my Vega risk going to change as implied volatility changes? So what happens to my position, like I mentioned before, is if implied volatility changes, my Vega is now changing. If I think implied volatility is currently priced at 30%, but should be 40%, and then implied volatility goes all the way to 50%, now I think implied volatility is too high, and I have more Vega. Because with VAMA and Volga, it's all about that slope, right? The change in implied volatility for the change, the change in Vega for a change in implied volatility. It's not the absolute change, it's how rapidly that Vega is changing. So for Volga, I think it's best visualized here with these out of the money options. The Vega is increasing because the slope is increasing as the implied volatility rises. So as implied volatility rises, my Vega risk rises. So if I think implied volatility is now overpriced, I have this great benefit of having a larger percentage return, but I also now have more risk. And I have to keep that in mind when I'm trading options. When I'm trading an at the money option, the Volga risk is a little bit less because the slope is pretty consistent. But for a parabolic return, I'm adding this incremental risk of having more Vega when volatility goes higher. So if I, just like I have to at some point take profits by selling out my stock when it's going higher, otherwise I'm going to be taking a stop loss type position, I have to do the same with my Vega position when I see implied volatility rise. That is the thing that I think can oftentimes be very difficult to understand for people, is that Vega increases as that volatility increases, especially on the out of the money options. All right. For Veta, I forgot I had a little more here on this. The Palmer Volga has that self-fulfilling prophecy effect. So as implied volatility rises, people tend to reduce the position sizing, which can lead to more movement and higher implied volatility. So we have more expected movement as the movement happens. So that's a nice benefit of being long options, is that as the implied volatility rises, it has a naturally occurring increased expected movement in the stock. And when implied volatility falls, position sizing does increase. So as I'm losing money on my Vega position, I'm actually naturally expecting myself to lose more. So I have to also look at that with VAMA and Volga as I'm trading my Vega positions, okay? Veta, going back to that now, is the rate of change in my Vega for the change in time. So it's really just moving from one line down to the lower one. As you can see, as time passes, the slope gets less. It's not as steep. That's because the Vega decreases over time. So as Vega is decreasing, my Veta is causing that Vega to be less. Even more so on the $120 calls, as you get down to like a day to expiration, there's really no change in the Vega because these options are worthless. These options expiring in a month, you can see how rapidly those can decay if we just sit here and don't move. So not only is theta hurting me, but I'm losing the slope here and I can't recover it from an increase in implied volatility. There's less time for this outlier event to occur, less time for an expected spike in realized volatility, and thus my Vega risk is dropping. All right, so changing in time, if I want to maximize my Vega, if I want a big Vega position, I need more time to expiration. And I actually want out of the money options in order to generate that leveraged parabolic type return. If I think implied volatility is high, then I need to start looking at shorter time to expiration and more at the money in order to prevent myself from getting that big loss of a pullback in implied volatility. All right. Now, the VIX right now is actually in a pretty normal range here, right around 20%. This is now pricing in an event, a couple of events actually. So right now we've got earnings coming up right now. So earnings season is going to be an event for the market. We've got tensions in the Middle East. That's going to be a potential cause of volatility for the market. We've got everything going on in China is causing a lot of movement in the market over there, the Chinese stimulus. And of course, within the next 30 days, we've gotten an election. And so all of these inputs are causing an increase in expected movement for the market. And as we resolve issues, such as getting knowledge of how the hurricane is going to impact everything down in the southeast, as we resolve these issues, the market's expected movement starts to go down because it starts getting priced into the market. And then we don't have that input as an impact, an unknown. Whether it's good or bad, it's now known. All right. So we can always hope for the best. But even when a bad situation happens on, say, earnings, when that stock falls, even though it may have fallen 20, 30, 40%, the implied volatility usually comes down because now we know that the company had poor earnings. The market has already moved. The stock price has already moved. And now it's time to just figure out where we go from here. And if I look at the term structure of the VIX, that's also pricing in this uncertainty being in the shorter term. So a lot of this stuff here at the front is built off of the election. So we've got an election before this term expires because it's 30 days of movement. So in mid-October expiration is about the next 30 days of movement, which gets us all the way out to mid-November post-election. All that stuff is being priced into the term structure of the VIX. Long term, we're looking at a little bit lower, but the implied volatility in the longer terms doesn't tend to fall as much as the shorter terms as we get these knowns out of the way. As new potential inputs that could cause volatility become knowns, that reduction is more about short-term VIX, short-term fear, short-term uncertainty. We're checking the boxes and eliminating those. Those long-term options have a lot more unknowns. They might have multiple earnings cycles. They might have multiple non-farm payrolls. They have all sorts of economic inputs that could cause shifts in the market. Okay? And they have to continue to be priced in. While this option only has one non-farm payroll and they all have one election, this will have 2 non-farm payrolls, 3 non-farm payrolls, 4 non-farm payrolls. So you can see why there's a natural downward slope when there's a lot of unknown in the near term. And then if we have nothing unknown in the near term, it goes the other way. Short-term implied volatility gets low and long-term implied volatility is higher. So when I'm going for a trend trade, I traditionally try to simplify the stock replacement. And this is because that way I'm eliminating some of those increased risks of Volga and Vama, and I'm reducing some of my Veda risk. So I'm trying to reduce those second order Greeks. So I use an at or in the money option. I try to get 3 to 5 months to expiration so that I don't have as much of a drop in that implied volatility when the unknown becomes known. And then I use some discretion on this to try to optimize my potential return from my volatility analysis of the term structure of volatility. I use an in the money call, at very least at the money. And again, I try to use some discretion on this to try to optimize that potential return from my overall volatility analysis, because as I see implied volatility getting to lows, that may change the delta that I use. But in the general range, 60 to 80 delta calls with 3 to 5 month expiration, that tends to give me a little bit more safety from some of that Vega risk, excuse me. At the very least, I want to do my best to eliminate Volga and Veda risk. And then I want to reduce my Vega risk by understanding which options term and how far in the money I need to use so that I can focus my risk on delta and prevent myself from making that catastrophic error of being correct on the direction and lose money anyway. All right. I hope all this just made some sense to you guys. I do have some time for some further questions here. If you have questions that arise afterwards, always feel free to contact me. Keith@optionhotline.com. Call me 312-600-8004 and keep an eye out for support@optionhotline.com for the free giveaways. Again, I really appreciate you guys coming in here today, and I hope that this has helped you understand some of the maybe unseen risk of options when you're evaluating how to trade a directional bias.
Thank you so much, Keith. I'm going to ask you to leave that on the screen just for a minute so anyone can write down information on how to contact you. And we have a couple of minutes if anybody has some questions regarding the presentation. We are getting a question right now from Brad regarding the recording. Yes, Brad, Avant-Garde will be sending out an email tomorrow with the link to the recorded replay. That email is going to come from info@tradeagt.com. So if you haven't already added info@tradeagt.com to your accepted senders list, please go ahead and do that so we don't end up in your spam folders. All right, so that is the information there. We are pushing right up against our time frame here, but if anyone has a last minute question for Keith to address live regarding his presentation, please feel free to type it. What most often happens, and Keith, you're aware of this, you know, most people will wrap up a webinar and then eventually an hour later or in the middle of the night or the next day or two, a question will pop into their head. So if that happens, no worries. You can feel free to either send the question directly to Keith via his email on the screen, or you can send it over to us at Avant-Garde and we can get it over to him if need be. All right. I want to thank everybody for taking the time out of their schedules to join us live today. We do appreciate it. And I want to thank Keith for taking the time to join us and putting together that presentation. As always, we appreciate your time and the education. We will see you back here for another free Avant-Garde trading webinar. We have one coming up next month in November with the OIC. Please feel free to sign up at your leisure. And until then, good trading to everyone. Thanks, you guys.